Good afternoon. Thanks for joining me on this web presentation of real estate investing. If you clicked on this video, clearly you're interested about real estate investing, and that's exactly what we're going to talk about for the next 20 to 30 minutes. Is everything to do about real estate investing, how to do it correctly, how to value assets, asking questions on why you want to do it. We are a professional private equity firm that specializes in multifamily real estate. So we do this all day, every day. And we're putting this video together. I'm putting this video together on behalf of our company just to help some people get better awareness of what we do and kind of explain our thought process and how we successfully invest in real estate year in and year out. So, a little bit about me. You might be wondering who I am and why you should even listen to me. So, a little bit of background on me. My name is Speck. I'm one of the managing partners here at Prospective Capital. I grew up on a farm, about 1,000-acre row crop farm. That means we grew corn, wheat, and soybeans here in Northwest Ohio. Now, I'm very grateful for that background or growing up around that because I was taught a lot of cool things, or very, very valuable things when I was young. One of which, of course, is hard work, that you work until a job is complete, not just by the hours. You work until the job is done. Sure, that's a good mentality to have. It's a very American mindset, and very good. The other thing that I was taught is to think in generations, not just in days, weeks, months, or years. The things that you do today will affect your life a year from now. They're also going to affect your life 10 years from now and your kids' lives 10 or 20 years from now. So I don't know how or why that is, but that's what I was taught from a very young age. And I actually got taught a really good lesson. I'm going to tell you a story. I was about 8 years old, and I was riding in this tractor right here that you see on your screen with my grandfather. And I think my grandfather is 75 years old, something like that at this age. And we're out on the field, and I looked at him and I said, "Grandpa, how long does it take to buy a farm?" And or how do you buy a farm? Something like that. And he said, "Well, it takes your whole lifetime to pay for a farm." And sometimes when you're a kid, you got some profound thoughts. And so I'm 8 years old, and in all my infinite wisdom, I'm like, well, let me check my inventory of lifetimes that I have on hand. I only have one lifetime. And that sounds like a terrible business proposition that it takes your entire life to pay for a farm. And so I think I even asked him, I'm like, bro, grandpa, how the heck do you grow a farm if it takes your entire life to pay for, an 80-acre field or something like that? And so I didn't understand it at that time because I'm young, but for some reason that stuck with me. And we'll come back to some of those conversations that I had with him. And even when we could talk about the whole hard work thing that we were taught, or I was taught when I was young. Sometimes it's not about how hard you work. It's about the opportunity vehicle that you're in. One thing that he also would say, my grandfather, is work smarter, not harder. Okay. So if you can figure out a way to do something and get it done half the time with half the effort, that's not being lazy. That's being smart. That's how you get more stuff done. So long story short, how do I go from being a little kid, growing up on a farm, to getting into private equity, and now we specialize in real estate here at Prospective Capital. Um, Basically, I was looking for a better opportunity vehicle, and I got involved in investing. Went to university, got 2 degrees from Ohio State, one in cognitive neuroscience, one in agribusiness and applied economics. Um, Thought I was going to do either commodity trading or investment banking. Ended up making more money for myself than either one of those jobs could pay me out of college by investing. I was investing in the stock market at the time primarily, and I said, well, I'll just kind of do my own thing, and I'll just keep investing. So, uh, long story short, this brings us to why real estate. So, the question that I'm going to ask you after telling you those stories and kind of hooking you in is: have you ever? You're on this. Clearly, you have a reason, because you're interested in real estate because you're listening to this either podcast or video here on YouTube. Have you asked yourself why real estate? Why? Okay. Yeah, sure. You could go on these social media sites like Facebook. Um, let's see if I can hold on. Yeah, like Facebook or Twitter or all these different social media sites, and people are all talking about real estate, real estate, real estate. It's a super hot topic. Are you here because you want to get rich quick scheme? Or are you here because you're actually truly interested in what real estate can do for you if you do it correctly, if you're working correctly at it? Um, and you need to figure out that why before you get to the next level. So I'll give you an example of my why. I told you that I'm a professional investor. That means I make my living from investing, and I do it full time, day in, day out. I've been doing it for quite a while, full time. um, Obviously, I'm also a partner here at Rust Belt Capital. So why do we at Rust Belt Capital, and why do I like real estate? Why do I buy real estate? And basically, because my answer to this why is because there's a basic 3-part formula to become very successful in investing. And I actually maybe ripped Warren Buffett's formula off, and it's good assets, leverage, and time. Okay. So it sounds simple, but there's some difficulty to it. So the good assets thing, first of all, is a challenge because you have to be able to identify a good asset. Okay. And the more simple the asset is, the easier it is to understand. So that's an advantage to you as an investor. Okay. So when I was thinking about how can I implement this strategy to enhance my returns, I needed to find an asset class that wasn't a one-off thing, and it needed to be something that was simple to understand and wouldn't take an arduous amount of time to work through the financials on. And so that's how I got into finding or identifying the asset class of real estate, because okay, it's a very simple business. It's well understood. That means your lenders understand it and they're okay with providing debt on it. And I don't have to go through, you know, the cash flows, the income statement, the cash flow statement, the balance sheet, like an investment banker would, um, and spend, 2 weeks trying to figure out what's going on one business. I can basically underwrite a property, um, in an hour, right, and do a pretty good job, pretty detailed job, and have an idea of yes or no, right? So the one thing is to be good investors, good assets. Next thing that comes in is leverage. So that's the next part of the formula to be very successful, abnormally successful when it comes to investing is leverage. And all leverage means is you're borrowing money. Now, why would this work? Okay, so I would say, and I think this is okay to say, is that we target a 15% return per year for our cash investments for our investors, right? That's the minimum equity return that we want. Okay, so if this is our equity up here, and I'll put an E, and our debt we can get today for even 7% per year. Which one's cheaper and which one's more expensive? Our equity is worth 15% a year, and we can borrow for 7% a year. Okay. So that means when we use leverage here, we can enhance this equity return. That's how you go from, your 10% return that you get in the stock market to the 15% return that we're talking about. As long as you're buying, good assets up here, then we can get to that 15%. Maybe. I mean, no guarantees, nothing's guaranteed. But that's the trade-off between debt and equity. If we're talking, if we were in a finance class, we call it the weighted average cost of capital. We talk about that, WACC. But we're not in finance class. We don't need to get that crazy about it. We don't need to get into the weeds because it's not that intense. So after you've got good assets and after you've got leverage, then you just need to give it time. Okay. Why time? Okay. I think CNBC was interviewing Warren Buffett or Charlie Munger once, and they asked him, you know, Warren, what's your favorite holding period? And he said, our favorite holding period is for forever, right? Because there's a it's called the Pareto principle, or 80-20 is another word. 80-20. That means 80% of your gains come in the last 20% of the time that you hold it invested. And that's because when you invest in a compounding asset, it's an exponential function, right? So an exponential function looks like that. So most of your gains are going to come in this last 20% of time here that you see. So that's why time is super important. So when we underwrite deals and we bring deals to our investors, we're always talking in a minimum of a 10-year time frame. And you're like, man, that's a long time. And it's like, yeah, it is a long time. But we'd rather make dollars, not pennies. Okay. We're not trying to flip things because the real wealth is created over time. It's not created in a year or two. Go back to that farm example that I had growing up. It's think in generations, don't think in a year or two. So let's actually make some of this tangible. What I mean by good assets, leverage, and time, which is the core understanding or principles or ideas that we have at Rust Belt Capital. So here's an example. Let's say that we can identify uh, an apartment complex that we want to buy, and I think I have, yeah, I have this little picture here of such a beautiful little apartment complex. So assuming that we're able to do the due diligence and identify it as a good asset, here's the things that we get as an investor, and this is why it's very, very, very attractive. First and foremostly, we get monthly revenue. Okay, we get cash flow is another way to say that. Every month we're getting money coming into our account. The next thing that we get is, since we're using leverage and the type of leverage that we're using, somebody else is paying our mortgage. That means we put $1 down. That's our down payment. We can borrow the other three to get the entire value. So if we're paying 4 million for this asset, let's say we only have to put 1 million down. We can borrow the other three, um, and the other three that we borrowed is going to be paid off by the people who live within the property. So somebody else is paying your mortgage. So odds are you might have a house that you live in today that you own. Every month you have to make that mortgage payment. Okay. You've probably heard on Wall Street Journal or one of those CNBC, one of those reports that the number one habit that millionaires in America make or have is that they pay their mortgage. Okay. And that's their best investment. Well, here's the problem with that. Number one, the house that you live in, your primary residence, is not an investment. I don't care what anybody says. I'm sorry if that offends somebody, but it's not your your primary residence is not an investment. Okay. Because you have to have a place to live. Sure, yeah, you could downsize or whatever, but that's not a realistic, I mean, that's not realistically a good option. Okay. So it's not an investment, but it is one thing that builds basically dead equity. Anyways, we'll move on to the other part. So if we buy an investment property, though, and it is big enough, it is an apartment complex, private equity investors or investors like us view it as a business, and meaning we have options to increase the value of the asset. And we're going to talk about how we increase the value of the asset and how that actually works here in another second or two. Now, the last part that we're going to talk about in this slide is that an asset that produces cash flow is a hedge against inflation. And this is particularly important or pertinent in today's day and age because for the first time in 30 years, we've actually had real inflation. Okay. And we can see this in assets. For example, look at homes, retail homes, like ordinary homes that people want to look at. The government printed 1/3 of all the money in 2020 and 2021. They printed 1/3 of all the money in circulation to have ever been printed was printed within that period of time. Okay. So they inflated the money supply by 30%. What happened to tangible assets? Tangible asset values went up by 30%. So if you just had $100,000 in the bank versus $100,000 home, your $100,000 home is now worth $130,000, and the $100,000 in the bank is still worth $100,000. Okay, meaning you lost $30,000 on your buying power because all the assets inflated. That's why we want to get out of cash itself and rather have an asset that produces income that we can denominate it in whatever currency. Because we buy this building here, okay, I can write it up 4 million bucks in US dollars, or I can convert it to reais, which is a Brazilian currency, right? And I can say, okay, it's 20 million reais. Okay, it doesn't matter. I'll sell it to you in reais, or I'll sell it to you in US dollars. It doesn't matter anymore because this is not a bank. It's not necessarily like a bank account, you know? So that's how you hedge yourself against inflation, but it's very, 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 very important that it produces cash flow. Okay. Gold is not a hedge against inflation, even though people want to say it is, even though if you've ever listened to like a Rush Limbaugh or if you listen to Glenn Beck or something like that, they'll say gold line and they'll do some type of I don't know, infomercial for them. I think that's terrible. That's dumb because Warren Buffett says that's dumb. I think that's dumb because it doesn't produce any type of money. It's not, that has no intrinsic value. This is the same reason why cryptocurrency is not a real investment. It's speculation, and it's not good. Anyways, I digress. Let's move on. So I talked about cash flow. Okay. And that's why, one reason why we really like these properties as a private equity investor. But what does that actually mean? Well, I can tell you an example of why it's important to me and why, if you're getting near retirement, it should be very important to you. So when I was like 23 years old, I'd been investing for myself, making a pretty good income, pretty good living, right? Um, and I wanted to buy this 55-acre farm, and it had a house on it. I wanted to buy it, right? So I went to the bank and I tried to apply to get some loans, because back to the whole debt versus equity, what's your equity worth? What's your debt worth? Et cetera, et cetera. You could borrow at 3% back then. And I was making I was actually making way more than that. We're not going to say how much, but I was making way more than that on my equity. Um, so anyways, I go to the bank and I can't apply for a loan because all of my income is coming from capital gains. Now, capital gains is good, but at the same time, I had no cash flow, minimal cash flow coming in. Um, Only what I needed, right? And so it looked like I wasn't making a bunch of money in the standard procedure that banks use. Okay. So this was a major problem. Here's the crazy thing: I had enough money in the bank to literally write a cash check for the amount that I was requesting for them to borrow. Actually, more than just the cash. I had like plenty of money. So it wasn't a money issue. It was a cash flow issue. Okay. So if you're getting towards retirement and yeah, you have a 2 million, a 3 million, a $4 million uh, bank account. Okay. If it's not producing dividends, if it's not producing cash flow, that's a problem for you, because if you want to buy something in your retirement, you're going to have to sell, um, some stocks in order to go and pay for that or afford it. It limits your ability to borrow. Okay. So cash flow is super duper important. And I had to learn that the hard way. Thankfully, I figured out how to get a loan on the property and how to make it all work. But it, this is a big reason why we, as a private equity firm today, why we get into real estate, is because of this cash flow that comes here. So literally, we can buy an income. Okay, that's a that's a pretty cool way to retire. You can buy an income. Um, I told you this story about me trying to borrow from a bank without having sufficient cash flow, even though I had more money in the bank than I was actually asking to loan or borrow. Um, and then the other thing would be is you can actually replace your income with these types of investments than having to work. So earlier in this presentation, we talked about somebody else is paying your mortgage. And so let me go to Bankrate and let me actually show, I think I have it up here in one of my tabs somewhere. If not, I can just click on that. Yeah, I can just click on this, I think, right? Yes. Okay, so you should be seeing my screen now still. So this is an amortization calculator. And let's say we take a $3 million loan. It's a 30 years, and let's say it's 7.5% interest. And we can actually look at how it works over here. So when somebody else is, this is another reason why real estate is very, very, very attractive, especially as a long-term investor, is if you get an amortizing debt note. Okay, sure, this interest, people, this green line right here that you're looking at, that's your interest line. People are like, man, look at the end of it, you paid $4.5 million in interest. And it's like, no, you didn't. The people living in the apartment complex paid $4.5 million of interest. You only paid $1 million, say, assuming that we bought a $4 million property. You only put $1 million down, and then all this other $3 million, look at it gets amortized off. Okay, principal paid, that's the light blue. Loan balance is the dark blue. See how it crosses? Boom. It's all paid off. And I guarantee, I can't guarantee, but I'm very, 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 very confident by 30 years from now, not only, we asked, would you have paid would the $3 million have been paid off that somebody else is paying off for you. Um, but the value of the property is going to be much higher than $4 million. Okay, and we're gonna go over why. I think in 2 slides, no, one more slide, and we'll go over why and how it works. The holy grail formula of investing. This works if you're an investment banker or whatever. If you're a professional investor, it powers all investments. But think about this. Somebody else is making every month these mortgage payments for you. So all of this money here is going to be money in your pocket as long as you just hold on to the property, right? And so that's a key thing. Um, if you're interested in doing this, here's the URL link to it, bankrate.com/mortgages /amortization hyphen calculator. Go play around with it. It's pretty cool. So I said we're going to get to the formula that's really important on how do we increase the value of a property? How do we increase the value of apartments? And it's right here. So if we increase rents, we increase the value of the property. Let me say that again. We increase the rents, we're going to increase the value of the property. Why? Okay. So if I ask you, what is a property worth? How do you answer that question? Okay. This was for me when I was learning how to be an investor. This was actually a very challenging question that took me a year to figure out because I had nobody to teach me. And I'm literally going to tell you right now the formula for how it works, how all investments are valued, whether it's investments in the stock market or whether we're talking about investments here, real assets like real estate. The formula is this right here: cash flow divided by rate of return or desired rate of return equals the value. That's why it's so important to have cash flow. What does this mean? Okay, let's say we have a 60 unit apartment complex. Okay, so we got 60 units. I'll write it over here. Actually, we'll go to the next slide. Remember this: cash flow, rate of return divided by that equals the value. And we're gonna do the formula right here. So we have a 60 unit apartment complex, and we're going to increase rents by $100 per door per month. Okay. What does that mean? That means we've increased the cash flow of the property by $6,000 per month. Okay. Follow me? You got 60 units. We increase it across the board by $100 per month. That means we got $6,000 of new cash flow per month. Why is it new cash flow, net cash flow? Because realistically, to get this $100 per month rent increase, our expenses are already, for the most part, pretty fixed. So we have fixed expenses, but we've increased our top line. In a year, that's $72,000. Okay. Assuming you collect it all. So what is this $72,000 worth? If this $72,000 is cash flow, we can do this: 72,000 divided by, we're going to figure out our rate, and that's going to give you our value. This is 72,000. So what we're doing right now is figuring out how much value we've added to the property. Let's say we're in a tertiary market, we're in a cash flow market, and it's an 8 cap market. That means we're looking for an 8% rate of return. Okay. So what we can do, and I'm going to pull my calculator over to do this. We're going to take 72,000 and we're going to divide it by 0.08. That gives us 900,000. So we've increased the value of this property by $900,000 just by increasing rent $100 a month on 60 units. Okay. That's the holy grail. Okay. Of investing. We can also, I can add another slide here and we'll go through that. So that's how it works. That's how value add, essentially works. Sorry, I was writing all this stuff down. I didn't switch the slide. We'll go back to it. 60 units, we increase it by $100 a month. That's $6,000 a month, or $72,000 a year. We take 72,000, we divide it by our cap rate, which is 8%, and that gives us $900,000, or we increase the value of the property by $900,000. That is a value add play. Now, there's nuances to it. We're not getting too far into the weeds on it. No, obviously, I mean, we probably could. Why is it? Yeah. But that's essentially how it works. Now, let's go through. Let's take this example and let's think about it. You're probably going to ask me, okay, Stephen, how do I underwrite, or how do I run the numbers on real estate? So let's expand this example and we'll talk about that. So let's say we have this same 60 unit apartment complex. So we got 60 units. Okay. Yeah. So we have 60 units. Okay. And let's say we need to figure out, first of all, what is our top line revenue? So we need to figure out our top line. Let's say we get paid $500 a month for each unit. That's the average rent. Okay. 500 times 60. 500 times 60. That's $30,000 a month. So our top line is 30,000 per month. Okay. Now we're going to assume, so if this is our top line, now we need to take out our expenses. What are our expenses going to be? To be conservative, we can say 50% of this is going to be expenses for like maintenance, repairs, capital improvement, capital deferred maintenance or capital improvements later on, taxes, insurance, all that type of stuff. So we're going to subtract out 15,000, and that gives us 15,000. Okay, per month. This is per month. Okay. Now we need to know what our debt's going to be. Okay, because it says, so this is, if we paid cash, this is what we'd get every single month. We can multiply this by 12 to annualize it, meaning what is it per year? So 15,000 times 12, it's 180,000. Okay, let's add another slide. And we're going to carry it over. So we're making 180K per year. Okay, we haven't added any of our debt yet. This is just cash numbers. So we're making 180,000 per year right now. What is this worth? This we can then take and we can do what we did before, which is this. Another word for this is net operating income. Okay, NOI, net operating income. So we'll take 180,000 and we'll divide it by the cap rate of the market, and we're going to say we're in an 8 cap market. So we take 180 divided by 0.08, and that gives us 2.25 million. 2.25 million. Okay. We've only been working with cash numbers right now. So we'll go back, we'll review. We have 60 units, and we're trying to figure out our top line revenue per month. 60 units times $500 a month per unit, which is our average rent, gives us $30,000 a month. We need to figure out our expenses. And to be conservative, we're going to say our expenses are 50% of our top line revenue. So that's 15,000. That leaves us with $15,000 of cash to work with every month. And now we need to get it to an annual figure. So we multiply by 12, which brings us to $180,000 of cash per year, which is our net operating income. Once we have our net operating income, we can value the property based on this cap rate. This is our cash flow divided by our cap rate, which is 2.25 million. Okay. So that's the value of that property, is 2.25 million. Now, does it work? Stephen, does it work? Okay. We need to figure out how much is this 2.25 million. How much does it cost us in terms of debt? Do we have to pay 100% cash for it or what? And that's how you figure out how much you can borrow. Okay. So if we have 2.25 million, just say we have 2 million to make it simple. So we're valuing it at $2 million. Could we put $500,000 down? Maybe. And then borrow the rest, which is $1.5 million, maybe. But then we have to ask, if we put 500K down, and that's our equity, how much is this remaining 1.5 million going to cost us? Okay. So we have 180,000. I'll write that over here. We have 180 to work with per year left after all of our taxes, maintenance, insurance expenses, all that type of stuff to pay for this 1.5 million. Well, if we're doing interest only, which we're not, because you're going to have to amortize it on a property this small. If we're borrowing it at 8% debt, our interest at 8% debt, our interest alone is 120,000 a year. Okay. So that leaves us $60,000. If we were interest only at 8%, we would pay estimated roughly 120K in interest. So we could take our 180, which is our NOI, subtract out this 120, which is our interest, assuming we're interest only, which we're probably not going to be at this small of a amount, and we're left with $60,000 per year. So how do you find out if that's a good deal or not? Okay, well, we can take this 60K, assuming we're interest only. We can go 60K divided by 500,000. So if we do 60,000 divided by 500,000, that's a 12% cash on cash return. 12% cash on cash. Is that a good return? Yeah, I mean, if it's starting out at 12% cash on cash, yeah, that's probably a pretty good return. Now, you're going to have to ask more questions like, what's the likelihood of actually being able to execute this? Can I actually get interest only at 8%? Questions like this. And but generally, this is the mathematical formula that you're going to go through. So if there's one slide to remember from this presentation, it's this one over here, which is cash flow divided by rate of return equals value. Now, why is it difficult? Because you have to figure out how to calculate the cash flow, and then you got to figure out what the market rate of return is. That's your cap rate or capitalization rate. Capitalization rate just means if I paid 100% cash for this property, what would my rate of return be? Okay. And so that's going to be market by market. I can't tell you what it is in Miami, Florida today. I can tell you what it is probably around Western Ohio or somewhere in the Midwest. I have a better understanding of that. I don't know what it is in New York City. I don't know what it is in California. And the reason I'm telling you that is because you're going to have to go out and figure that out. What are properties trading for? So you're going to have to go out and you're going to have to figure out how to calculate cash flow. You're going to have to calculate it many, many times. And then you're going to have to see what, these cash flows are selling for. And that'll show you what your rate of return is or what the cap rate is in the market. And that tells you how to value the property relative to the market. Now you could say, I like that. And you could bid on something. You could say, I don't like that. And then you just have to keep looking or bid low and see if you can get something. So anyways, if you'd like to know more about our private equity company, Rust Belt Capital, you can email us at investor@rustbeltcapital.com. That is investor@rustbeltcapital.com. You can also visit our website, www.rustbeltcapital.com, www.rustbeltcapital.com. We have tons of information like this on our website. You can subscribe in the footer of our website. You can subscribe to our complimentary weekly newsletter. We send out information very briefly every week, once a week, about what's going on in the market, what we're seeing, updates on projects that we have under our belts. We've done several successful projects so far. We're going to do more in the future. If you're interested in participating on any of those, you want to get on that email list or email investor@rustbeltcapital.com. We'll be happy to jump on a call and talk to you. And I hope this presentation really helped you out and provided some value. If so, please like, share, and subscribe. Leave me a comment down below, things that you liked or things that you want to learn more about. And I'll hopefully be able to put together another video and answer those. So thanks and have a good day.